Okay, let's kick off 18.2 work together, which again is on our long-term debt financing. So it says that we have the journals and a loan payment schedule for a company called Lambers Stores. We're going to assume that it's the current year and we're going to journalize the following transactions on page 6 of a cash receipts journal and page 12 of a cash payments journal. We will need to refer to the loan payment schedule listed below here when we journalize the December 1st transaction. And then they also give us our source documents. So remember, this is a loan payment schedule. We saw that earlier in the lesson. And then we have our transactions listed here. So we're going to start off with on June 1st, we signed a 5-year 9% note for $25,000. So that is going to go in our cash receipts journal because we are receiving cash from that transaction. It's one of our long-term debt financing options. So we're going to put in June 1, and then our account title is going to be long-term note payable. Notes, I guess. Notes payable. Again, it's long-term because it's longer than a year. It's 5 years here, so we're going long-term note payable. Our document number is R337, and then the payable is going to be credited for the total amount, which is $25,000. And then our cash over here is going to be credited for $25,000 as well. So that's our June 1st transaction. Then it says on July 1st, we issued a 20-year 6% $5,000 bonds for a total of $200,000. So again, that's going to be cash receipts because we're receiving cash from that transaction. We're asking for financing, creating a liability, but receiving cash. So we put July 1 here, and then our account title is bonds payable because it is a bond. And our receipt number is R345. And again, this is going to be a credit. We're receiving the money, but our liability is increasing for a total of $200,000. Get all my twos in there. And cash debit of $200,000. So those ones are pretty simple, not too crazy, as long as you know if you have a long-term note payable or if you need to have a bond, and just make sure you read the transaction carefully for that. Now let's look at our December transactions because we're going to be paying our payments and our semi-annual interest. So of course that's going to go in cash payments journal. So let's look at our December 1st transaction to begin with, which says that we paid cash for the December payment on the June 1st note payable of $518.96. So what actually is happening here is this is the one we need to look at our loan payment schedule to be able to figure out how much goes to interest and how much actually goes to reducing our debt. So we put December 1st here, and then we go up here and look at our December payment, which is here. Our total payment, remember, is $518.96, but $174 of that is going to interest, and $344 is actually going in at reducing our debt. And I can scroll up here so you can see that this is going to interest, and this is going to principal. So we want to make sure that we can see that as we go here, but I can't show you it all, so just know that that's where that is coming from. So the first thing we have to put in our account title is our long-term notes payable. Our check number was 842. And remember, our notes payable is actually going down because we are reducing our debt. But for the amount that it is going down, we look at that principal payment for December, which was $344.08. So that's where that number is coming from, $344.08. And then our other account that needs to be debited is our interest expense, which is coming from the other one, which was $174.88. So we put that in the second line of the debit. And then the total, which was how much our payment is actually for, remember, always is the same at $518.96. It's just that as each month goes, the amount that you actually pay to principal increases and your interest goes down. And you can see that when you look at the schedule, is that your interest slowly goes down and the amount that you're paying your debt off by goes up. Okay, if you need to remember how to do this, that is, let's flip back here and see in our slides. It's, nope, I'm in 18.3. We don't want that. We want this one. Slide number 21 will give you the information needed to figure that out, as well as the schedule is on slide 20, which kind of, you need both of those to figure that transaction out. Okay, let's do our last one here, which is that we paid cash for the semi-annual interest on our bond. So our bond, remember, is the one that we issued for 20 years at 6% for a total value of $200,000. So let's put in the 31st here for our date. And then we are keeping track of our interest. So interest expense is going to be the account title that goes here. And then we have our check number 861. And how we figure out that interest expense again is that we take our face value, which was $200,000, times our interest rate, which is 6%, and then semi-annually is every 180 days divided by 360. Again, if you need to have a reference for that, it is slide 27. And this will give you the formula for figuring out that interest payment. So you just need to be able to identify your face value, interest rate, and then 180 over 360 for a semi-annual payment. So when we plug all of that in for us for this problem, we get a total interest expense of $6,000. So that's going to be debited, and our cash, because we're paying it, is going to be credited. So those are the 4 transactions that we are dealing with for issuing and then paying on our long-term debt financing.